Well, hello everyone. I am Tiffany Haynes, the Chief Operating Officer of Fingercheck. And here at Fingercheck, we really handle all things like earned wage access, payroll, scheduling, time tracking, benefits hiring, like all those things that small business owners really don't want to consume their time with. But today we're actually going to focus on one of my favorite topics, and that is earned wage access, which is a little bit of a new topic. It continues to evolve. And so I have asked Brian Axel, who's going to introduce himself here shortly, to just give a little bit of background about what he does. But I thought I would share, Brian, maybe how you and I got introduced. So I came to Fingercheck a little over maybe right at 2 years ago, and I was looking for outside counsel, somebody that was really familiar with the fintech space, the payment space, just to help me wade through financial services. So we had a mutual friend in the legal corner of our world. And so she introduced me to Brian, and I will say, Brian, like, you have yet to disappoint me. We always talk about a variety of different topics and something, fintech related usually, but I would say our inbox is probably most earned wage access right now. Like, we're usually flipping emails back and forth to one another throughout the week of like, hey, this is going on, this is going on. So I just thought it'd be fun if we did kind of just like all things earned wage access. Like, let's talk about the subject. Let's talk about what we are seeing in the space, what we're experiencing, me as a provider and you just as that legal counsel. So, but first, I think you should share a little bit about who you are, and please tell them about your lobbying days, because I think that's absolutely if you could just start there and then work us through like how you became a lawyer.
My misspent youth as a lobbyist.
Yes. We're going to come back to that lobbying topic here in a little bit.
Yeah, it's first of all, I can't thank you enough, Tiffany, for the invitation. I'm always happy to talk to you and talk about earned wage access in general. So I was thrilled to be here, and I was kind of just thinking about that mutual friend that introduced us. And I remember just this was a while ago, but I remember how I met her was we were working on the craziest product together, and this product was worth its own podcast, I'm sure. But just thinking back to that just made me laugh a little bit. So appreciate kind of the Wayback Machine there. So, my name is Brian Axel. I'm the managing partner of Axel Law. Managing partner is a little bit of a misnomer because I'm the only employee of Axel Law. I have So I'm not only the managing partner, but I'm the CEO, I'm the chief marketing officer, chief accounting officer, chief taking out the garbage officer. So I've been doing this solo practice for about 2 years. As Tiffany mentioned, I do have a political background. When I came out of college, I was a lobbyist in Washington, D.C. for the retail industry for a couple of years, which was a great experience. I had some really great mentors that really taught me how to be a professional and taught me how to write and just taught me about politics in general, how it worked. Then came back to Minneapolis. I'm Minneapolis born and raised, lobbied for a nonprofit at the Minnesota State Capitol here for a couple of years, and decided I didn't want to be a lobbyist anymore. And I went to an even more noble profession. I went to law school to be a lawyer. And then did that. I was supposed to be a real estate lawyer. My first job out of college was Target Corporation, the retailer. They had other ideas. They made me a banking lawyer. And I spent about 11 years at Target working on their financial services. We had 2 banks. We issued our Target branded red cards. So we had credit cards, debit cards, gift cards. I was one of the lawyers on that team. Then left Target, bounced around a little bit, was at a big law firm for a little while. Worked at a company called Blue Stem Brands for a little while. You may know them as Fingerhut. Then went to the Bancorp Bank for about 5.5 years. I was their chief payments lawyer. We worked on a number of different fintech programs. We were the sponsored bank for a lot of neobank programs. We worked with, did a lot of payment acceptance work. So we did a lot of ACH work, faster payments work, and learned just about how all these programs are structured, both on the issuing side and on the acceptance side. And was working with a lot of fintechs, a lot of startups, a lot of entrepreneurs, and I kind of got the entrepreneurial bug myself about 5 years in, and decided I was going to open up my own firm. So my firm is really just dedicated to helping banks and fintechs work with one another to form partnerships and to launch payment products. So, and obviously really thrilled to be working with Fingercheck. I always get excited when I see an email from you. I mean, I think it's always something interesting that I'm going to be working on, and something new, and some things that I'm going to need to be creative on. So it's always gratifying to get those emails.
Yeah, no, I love that. And yeah, we like to keep we like to shake it up and stay on the edge of things. So you're good to work with us and be creative with me because I like that area. Okay, so we're gonna kind of really double down on earned wage access, which I think is fascinating because it means a lot of different things. It can mean different things to different people. So I thought we just start out with some basic definitions so our listeners understand, right? Like, so it's like, is this a payday loan? Like, is it not a payday loan? Like, what is this whole, direct to consumer model versus the employer integrated model? So if you can just kind of walk us through
Yeah.
like some baseline, I think that'll help get us started.
I'm happy to. I think, I was thinking about this morning. I think, as we're talking about earned wage access, EWA. And I think it's a very well named product in terms of how it works. It really is based on the wages that employees have already earned that the employer owes them, and giving them early access to those funds. Normally, everyone knows about the every other week normal payroll, or the payroll on the 15th and the 30th of each month. And that's really kind of what we've been geared toward for the last 50 years. But I think we're finding out that normal 2-week pay cycle really doesn't work for a lot of people. They're just, you know, people have expenses come up, and that Friday payday really can't come soon enough. So this is where I think earned wage access comes in. It is giving people access to their earned wages before that payroll, giving them access when they need it. So it's really there, as you mentioned, Tiffany, there's really two different types of EWA out there that have kind of evolved out there. One, I think, is the more common one, and that's what's called the employer integrated model. And that these are providers that are integrating somehow with the employer's payroll information. So if you go to this provider and say, hey, I would like $100 of my earned pay, that provider can go to the employer's payroll system of record and say, okay, Brian Axel has earned, let's say $500. So we know we can advance him $100 for that payroll. So they have some relationship with the employer. The employer has authorized the provider to offer these EWA products to its employees. And so what happens then is that the employee requests that, the provider goes in and says, yep, Brian Axel has $100 available. And usually it's a percentage. They'll only loan, loan is a very bad term on this. They will only provide, up to a certain amount of earned wages. And that's, I think, first and foremost, make sure that, there's enough withholding that's available that's going to be due at the end of the pay cycle. But also, I think, to ensure that the employee doesn't borrow, again, borrow is a terrible term, doesn't get sent, and we'll talk about why it's a terrible term a little bit later on, doesn't get sent wages that exceed either what they've already earned or what they'll need to make the required withholdings on at the payroll cycle, whether that's tax withholdings, 401ks, things like that. So they send the funds to the employees. Sometimes it all depends on the program. Sometimes there's a fee involved, sometimes there's not. And then the provider then tells the employer, hey, we've advanced $100 to Brian Axel. And then when the normal payroll hits on that Friday, the employer then takes out $100 out of the check that they would normally send me. And they would send that $100 to the provider. So then at that point, the provider's been repaid, the transaction's done. Usually these programs are structured in a way that there's no recourse to the employee. So if the employer doesn't pay back the provider can't go back and try to claw back that money from the employee. And usually there's also things in the terms and conditions where a provider commits to the employee that they're not going to report any negative information to a credit bureau, or they won't, if the provider doesn't pay, they won't try to collect that unpaid amount from the employee, or they won't try to deduct any wages from that employee's bank account. So really the provider, their recourse is against the employer.
That makes sense. I remember working through a lot of that language when we were doing our pay on demand, like getting it integrated with the product and making sure like, hey, we've got all this buttoned up and we're not going to go back to the employee should something go awry.
Exactly. It's all I think, to ensure that this is not considered a loan, which is what we'll get to maybe on. The second model is called the direct to consumer. And it's also, you might hear this referred to as DTC. the real big player in this area is Earnin, where the DTC provider has no relationship with the employer whatsoever. They don't integrate with the employer system at all. What they do is that they're going to try to get data from somewhere else about the employee who wants the advance. Usually, I think that takes the form of some, the DTC provider is going to, engage a Plaid or some other data aggregator where they're going to get some access. The consumer is going to provision some access to their bank account. And then the provider is going to look in their bank account, look at their transaction history and say, okay, we're going to see when Brian Axel gets paid normally and how much he gets paid. And then they're going to make some judgment on, okay, if let's say we know Brian Axel gets paid $1,000 every other Friday. So we know that there's probably a pretty good chance that, come the next payroll date that we think is, let's say it's the 15th of the month, Brian Axel is going to have $1,000 direct deposit in his account. So maybe we're able to advance him $200. So they'll make that advance to the employee on a non-recourse basis. So much like the employer integrated model, they'll put in the terms and conditions. Look, if we don't get repaid, we'll talk about how that repayment works. We have no recourse against you, the consumer. They advance that $200 to me, and then when I request that advance, I'm also going to authorize that provider to take $200 out of my account on that Friday, on the 15th. So that's going to be all preset. That's going to be pre-authorized debit. Then on the 15th, that TTC provider is going to take $200 out of my account because I'm going to get paid. If that $200 comes out of my account, okay, the transaction's done. If it doesn't come out okay, so if it comes back NSF, that provider usually waives any recourse against me at that point. Again, it's to make sure it's not a loan. Usually there's a voluntary tip involved where there's not maybe a mandatory fee I have to pay, but I'll be encouraged to pay a tip. It could be, a fixed amount, could be a couple bucks, it could be a certain percentage.
Right.
It depends, but it's voluntary.
Right.
And if I don't pay it, the way these programs are normally structured is that it doesn't really, there's no repercussions, there's no negative repercussions if I don't agree to pay a tip, where I can go back and go get another advance down the road if I wanted to.
Right. Because there is a cost to the platform, like regardless of the model you use, it takes money. It took money to develop. It takes money to maintain. It takes money to move the money, especially instantly. That's become, I know, part of the hot debate of like tipping and fees and things of that nature. Like how much can you charge? But at the end of the day, like technology and innovation and advancement and moving funds faster cost money. So yeah, just striking that balance. I know on your recent kind of, well, it's been a few weeks, you made some 2024 predictions, which I love. I always like reading through what's in Brian's mind. So of course I was extra happy to see earned wage access on your list because I know we've been watching it pretty closely. So like, what are some things that you're seeing that you kind of expect to translate this next year and materialize? Why do you think that's important? And so I guess give us a little insight into your mind.
Absolutely. I think we're going to be very busy. I think the EWA industry in general is going to be very busy. Anytime you talk about regulation, our country is based on what's called dual sovereignty. So not to get too political sciencey here, but with dual sovereignty, we have the federal government and we have state governments, and both play a very significant role in regulation. I think we're going to see that play out this year. On the federal level, we have the Consumer Financial Protection Bureau, the CFPB, that I think everyone is familiar with. There has been, ever since these products came to be within the last 4 or 5 years, there's been a lot of debate, and this goes back to this topic that I foreshadowed earlier, whether EWA is a loan. I think the people who say it's not a loan say, look, this is just early payment of wages that are already earned. It's being paid by a third party, not the employer, but there's no recourse to the employee because they're just getting paid wages that they've already earned. And then any sort of repayment obligations at the employer. And I think that, that makes a lot of just logical sense. There are other people on the other side of the coin who do believe that this is a loan because there's some third party that wants to be paid back. Some third party is advancing funds and they want to be paid back, regardless of whether it's wages or anything like that. It's a loan. So those are kind of the two competing philosophies here that I think both the federal government and the state regulators and the state legislators are wrestling with. There, like I said, there's been the talk about, okay, well, is this a loan? It's not a loan. If it's a loan under Reg Z, Regulation Z is I think what people may be familiar with, is just kind of the federal regulation that governs how loans are made. It's a disclosure heavy statute. If you make a loan, you have to give several different disclosures that are required under Regulation Z. So people have asked, okay, if this is a loan, Reg Z must apply. We must have to give Reg Z disclosures. So there's a lot of debate about that. In 2020, the CFPB weighed in with an advisory opinion. This was issued, and the timing I think is important here from a political perspective. This was issued during the waning days of President Trump's administration. So the people that were running the CFPB were appointed by President Trump. They released an advisory opinion that said, generally, that earned wage access is not a loan. Reg Z doesn't apply. However, they put a lot of strings on that. So they basically developed a product construct that says, look, if your product follows this product construct we're going to set out in the advisory opinion, it's not a loan under Reg Z. It has to follow all the product constructs. And a lot of it was the stuff we talked about before, where, look, it has to be non-recourse to the consumer. It has to be wages actually earned by the consumer. You can't loan them more than what they've actually earned. You can't try to collect against the consumer. You can't report to credit bureaus about them. Importantly, the kind of probably the most significant product construct requirement was there can't be any fees charged to the consumer. So what it did is it created a safe harbor where it said, if you meet all these requirements, we're not going to consider you a loan under Reg Z. Reg Z doesn't apply. It didn't say, hey, if you don't meet all these requirements, it's automatically a loan. It just said, look, if you follow this, it's not a loan. Anything else outside of this, we're going to have to consider separately. I think the industry, by and large, is happy with that, other than the fee.
Yeah.
It's funny, right after that, around the same time that was issued, PayActive, which is a major player in the AWA space, came out. They were able to get what's called a sandbox opinion from the CFPB, where the PayActive product met all that, but they had a fee. I think it was an expedited fee structure, where if you wanted your fee, your EWA same day, you paid like $3 or something like that. Didn't meet the advisory opinion, obviously, because it had a fee, but they were able to get an opinion out of the CFPB that said, you know what, this isn't Reg Z or Reg Z loan either, even with the fee. Unfortunately, that advisory opinion, that only would apply to the PayActive product. And then I think there was some friction between the CFPB and PayActive later on. The PayActive later requested that advisory opinion be withdrawn. So the CFPB withdrew that. That's really no longer can be relied on for anything. So we're left with this advisory opinion that says it's not a loan so long as it doesn't have a fee. And an interesting development, so California the last couple of years has been working on a regulation that would govern earned wage access issued in that state. Maybe a little while, but the important thing is that they're considering EWA products as a loan. And there's some various kind of different rulemakings going on through California to develop this rule. And in the last round of comments, the CFPB issued a comment letter to the state of California and said, hey, state of California, we love what you're doing here because it's treating EWA as a loan. And here's why we think EWA might be a loan, which is completely different from the advisory opinion they issued in 2020. What changed? Change in administration. The Biden administration took over, they appointed their people, and they had a different philosophy on this sort of thing than the leadership that was appointed by the Trump administration. So I think they're taking a much more aggressive view on EWA that it's a loan. And they basically signaled in their comment letter, they really think this is a loan. And they've indicated that new guidance is going to be coming out in the next couple of months. Mm-hmm. So I think we're waiting to see what that guidance says. If I was a betting person, I would say that this is going to be considered a loan in some shape, way, or form. And Reg Z is going to apply, and the industry is going to have to figure out how to give these Reg Z disclosures, which can be complicated. It's not they're not the prettiest of disclosures. It's an ugly experience and complicated, but I think the industry is going to have to work through that in the next couple of months.
Hmm. What do you think some of the state responses are going to be to that?
So that's that great segue. Thank you. Like I said, we work in dual sovereignty, so now we've got the states involved, and the states are going through the same analysis that the CPP is. Is this a loan? Is this not a loan? And the states are getting increasingly active on EWA, much more active than I ever anticipated a year ago. I think last year we had 10 states consider legislation on EWA, and some of those states, those bills got quite a bit advanced. I mean, I think you had one chamber of the legislature pass bills on EWA and about 7 or 8 legislatures. So they came close, and we actually got 2 laws last year from 2 states. One was from Nevada that required licensure of earned wage access providers, whether they be player integrated or direct to consumer. And there were some restrictions that came with that. For instance, you had to offer, not only you have to get a license, but you also have to offer the consumer at least one free way to get EWA. Missouri also passed a law that required EWA providers, both employer integrated and DEC, to get registered. Little less onerous process to register than in Missouri than to get licensed in Nevada, but you still have to register, and there are some requirements there as well. Both states basically mirrored what the advisory opinion said from the CFPB, that just it can't have any recourse to the consumer, no credit bureau reporting, no collections, so on and so forth. Missouri didn't place any restrictions on fees at all. That's unregulated. So you have 2 states that, and they also, importantly, both states said this is not a loan under state law. This is something else, but it's not a loan, which I think the industry really, really liked. And I would also say that I think the reason why I think you saw 10 bills last year was that I think the EWA industry decided they were going to get out front of regulation, and they were going to push their own bills that they liked. So a lot of the bills you saw in the legislature were actually bills that were supported by the industry, that I think the industry helped draft to help line up bill sponsors and push the legislative process. Of course, you have the other side of the coin for people who do think it's a loan. And we are seeing some states think that this is an EWA loan. So in Connecticut and Maryland last year, they issued guidance. Their banking regulators there issued guidance, both in Connecticut and Maryland, that Connecticut said that anything, if you're charging a fee and that fee was over 12% APR of the advance, that was going to be considered a loan under their state law. It's going to be considered a small loan, which is where the 12% trigger comes from. Well, Maryland issued guidance that said, well, we're not entirely sure whether it's a loan, but it's probably a loan. But we're not going to say it's a loan.
Nothing simple. Nothing simple. Nothing's clean.
So case by case basis. And then the state of California is working on rules that would very clearly call this a loan, and that that EWA providers would have to register with the state. You wouldn't have to go get a loan license, but you'd have to register with the state. And there'd be all sorts of restrictions. You have to make reports to the states. You would fall under the state's finance charge caps. There's only so many fees you could charge. That, I think California is working very hard on that. I think you'll probably see some rules come out of California probably, I would say, end of first quarter, maybe sometime second quarter, something like that. And it's going to be that these things are a loan and people have to get registered and follow all the loan requirements.
Yeah. All very fascinating and happening, like you said, pretty quickly. Like we've just seen a lot of movement that and some of it's good movement, right? Like it was positive for all things earned wage access, and so that's great. Like if you were to, like, kind of going back to your lobbying days, I told you we were going to revisit your past. If you had just the opportunity to just kind of help shape the EWA policy correctly, or how, I guess, in Brian's eyes would be the correct way, like what would you want legislation to understand or see or think about?
Yeah, that's a really good question. I guess the way I would try to position this is that we've been looking for a long time for a way to get low cost, short-term liquidity into consumers' hands. There's just a definite need for that. I think, with inflation being the way it is right now, and with the economy the way it is right now, there's just a lot of people that are coming up short right now that need to have some sort of way to get kind of cash. That's not a credit card, or that's not a payday loan that's got 36% interest on it. And regulators have been asking for this for years. They've been asking banks to come up with something that, again, it's a relatively affordable way of liquidity to get liquidity into consumers' hands. And that's just tough to do because it's just by their nature, if these consumers need money, they might be repayment risk. And just from an underwriting perspective, it's and a savings and soundness perspective, it's kind of just hard to do from a financial perspective.
Mm-hmm. Right.
But here we have this tool now that's been presented that is really just based on what consumers have already earned and advancing those funds to those consumers early.
Mm-hmm.
And I think it's a great tool. Yes, there's probably going to be a cost to it, as you referenced earlier. I mean, for these platform providers, they're just, money's not free. There is cost involved that the providers are going to try to recoup. But it's certainly, a $3 or $4 fee certainly beats going to the payday lending store and paying 36% interest on $100.
Right.
I think this is a much more friendly way to do this, a much more efficient way to do this, and is just based on what the employees already earned. And if it's not
Mm-hmm.
this, then what else? I mean,
right.
I don't.
Yeah.
I don't know what else we do here to get liquidity into people's hands like that at a low cost basis.
Yeah, I totally agree. Like it is a tool, right? And like with any tool, is it perfect? It's not, right? But like everybody's trying to make progress. To your earlier point of just the structure of the pay cycle, we're still using our pay cycles based on the Industrial Revolution,
Yeah, exactly.
and it's just not working anymore. And so I think that's, some of the innovative things we talk about from a Fingercheck perspective of like, okay, how can we change that, or how does that need to look and feel differently, and reforming just payroll in and of itself. But, to get there, this is a great tool to help bridge, like, how do we want the future of payroll to really look and function. But, like we talked about, there's a lot of gray, there's a lot of ambiguity, there's differing opinions. I guess my hope is like we can all take a step back and really, think about that consumer, both think about how we want to protect them, but also we want to help them because that is their money, right? At the end of the day, they have earned those wages.
Yep, they have.
And those funds are a liability on that business owner, right? So, trying to figure out how to balance that and also balance it from the business owner's perspective too, because they have liquidity issues as well, right? They can't make payroll until they get paid, from their accounts receivable. So it's a big cluster of issues that converge, and we have to all solve different pieces and parts of it together. So yeah, really fascinating.
Absolutely. And I mean, speaking of the consumer, I mean, you're on the ground here. I mean, you see this every day. You interact with consumers with your platform every day. So, I'd be interested in terms of, what you're seeing on the ground with the employees that are using. I know Fingercheck has its pay on demand product.
Mm-hmm.
Interested to kind of hear kind of what you're seeing on a day-to-day basis in terms of, the demographics of the folks that are using this, whatever feedback you might be getting. Is there sort of a breakdown between hourly employees that are using this or salaried employees that are using this? How are they embracing this? Love to hear kind of your thoughts on that.
Yeah, so I think it, continues to be a journey. We've had pay on demand for almost 5 years now. Like I always say, like, before it was cool. And we've kind of reshaped that, especially like you and I, Brian, as I joined and then asked you to just kind of come alongside me in this, like reshaping how we want to go to market with the pay on demand product. So it's been interesting to just look at the data, especially over the last 12 months. But, just thinking about what we see from a demographic perspective, we also have to take into context, like we deal mainly with small business owners, 25 employees and under. We have very large like staffing companies that work with us. But, so when I think about that, it's always going to be a demographic that lends itself to the demographic of Fingercheck client from a small business owner perspective. And we tend to have a lot of non-desk workers, so mobile people out in the field, but they all have, essentially the same issues that we talked about, like liquidity and how do I get my money faster. So when we look at the data, we're seeing, I'd say the average transaction amount is around $140. So kind of going back to what you said earlier, like they're likely just looking for those quick expenses, like I need to pay my utility bill or I need to go get some groceries, things of that nature. And then like transaction volume is usually, if it's a repeat consumer, 4 to 5 transactions a month, right? So they're just needing an extra like one draw a week essentially. And that's just what we've seen kind of again in the last 12 months since we've kind of reshaped all things pay on demand at Fingercheck. We've moved probably around $5 million in just pay on demand, which, I guess maybe from the outside world, it sounds like a lot, but we at Fingercheck, we move 1.5 billion in payroll funds.
Yeah.
So, when you compare it to that, it's just kind of a drop in the bucket. But what I have seen in the data, and I was looking through it yesterday, just a really dramatic uptick these last 12 months, especially in the last 6 months. We see a lot of activity in our healthcare space and our staffing space, which makes sense, right? Like nurses, staffing, people that are working, various jobs through a staffing company, they just want their funds faster. So definitely seeing some trends there, but it is heavily on the rise amongst our Fingercheck clients. And it's great for like how we have our model is great for the business owner because they don't have to lay out the funds, right? So if I'm going to draw $140, like somebody has to fund that, right? And the small business owner doesn't have this extra liquidity and this capital, like to just be laying those out. So we do that on behalf of the employer. And then we deduct it at the back end from a payroll perspective. So it's just, that's kind of some of our secret sauce.
It's really a win-win for everybody. The consumer gets early access to their pay, and that employer has some liquidity to offer that early access to pay.
Mm-hmm. Yeah, absolutely. And I think too, like our model is, you talked about the employer integrated model and then the direct to consumer model. And you can, push back on me on this, but like we don't even totally fit the employer integrated model because there's no integration, right? Like we are the payroll system and we are the pay on demand system or earned wage access system. So when you talked earlier about like there's only a certain percentage available because you have to kind of account for the mystical withholding dollars and the mystical, like, did they actually work that shift? That did they actually punch in? Is there a delay in the time and attendance data? So there's always like with other employer integrated programs or direct to consumer programs, like there's always a risk model going in the background. And so for us, like we can take a lot of the risk out of that because we know what that employee's withholdings are. We know if they worked yesterday. We have that time and attendance data in there. So this like takes all the guessing out of it. And of course, like we still don't make 100% of their wages accessible because that's just not wise, right? From a balance perspective, but that's where we're really different than some of these other providers out there. Because again, like thinking like a small business owner, if you're going to go with like a daily pay or Zoom or what have you, there is an integration and you are therefore having to manage another relationship, another vendor. And that's a lot, right? These small business owners, particularly like in our niche, it's not like they have these huge HR departments or these, 15 office managers. They do in some of our larger enterprises that are on our system. But for those that are really downstream that need these tools, like these main street companies that keep the economy going, like that, they don't need more vendors to work with and more integrations to maintain. I mean, what small business owner wants to talk about is integration, right?
Yep.
Like they just want to run their business. And so that's really what Fingercheck brings from the pay on demand. Like we can just do it all for you. We'll do the math on the back end. You don't have to worry about moving money around. We'll lay the funds out. We'll deduct it from the payroll. We'll draft the payroll when we're supposed to draft the payroll. Right. It's just all there and just takes a lot of the complexity out of this very complex environment that we just described.
it takes out one very big moving part that you have to worry about, which I think
Yeah.
is kind of the special sauce of the Fingercheck program.
Hmm. Yeah, totally. Well, Brian, I loved our time together. Always like to hop on calls with you and just talk through this stuff because like you said, it's ever moving. So thanks for joining us today and just offering your expertise and your insight into the topic.
I enjoyed it. Thank you.
Yeah, you bet. Talk soon.
You bet.